Hey guys, let's talk about another issue that is in your book under the special issues having to do with receivables, and that is the disposition of notes receivable or accounts receivable. That's just a fancy word for saying disposing of notes receivable or accounts receivable. Now, in the ordinary course of business, you have a receivable on your books, and the customer pays you, and you have the cash now, and you take the receivable off your books. But there are methods of accelerating the cash receipt for receivables, and that's what we're going to talk about. Okay. So there's a couple ways you can accelerate cash receipts for receivables that you have. One of the things you could do is you could simply borrow money and use those receivables as collateral with your bank. Okay. Um, Receivables, if they are valid receivables, are strong collateral to back up your loan. So that is one thing that companies will do, is use the receivables as collateral. The other thing that they can do is they could sell the receivables to what we call a factor. Okay, a factor, it is a finance company that buys receivables from businesses for a fee, and then they collect money from the customers. Okay. Now let's go ahead. I wanted normally in class I use three students kind of to illustrate how this works, but we don't have students here on an online class, so let me use something else. Just a second. Okay, let's say we have a customer. Let's say Homer is our customer, and let's say we have a seller, and that is Captain Crunch right here. Captain Crunch sells cars, okay? And so Homer Simpson wants to buy a car, and this car is $10,000, okay? So Captain Crunch sells the car to Homer for $10,000, okay? Normally what would happen here is Captain Crunch now has an accounts receivable on the books from Homer for $10,000. Okay? However, let's say that accounts receivable is not due for 6 months. Let's say it was they were offering a 6 months no payments sales policy or something. Okay, but Captain Crunch needs the money now. Well, what you could do then is you could step in and have somebody. Let's say that Spider-Man is the factor. He's the factoring company or the factor. Okay, so what you could do here is Spider-Man could give Captain Crunch maybe, $9,500 right now, and that receivable would then be off of Captain Crunch's books, and it would be on the factor's books. So now Spider-Man has an accounts receivable from Homer for $10,000. And when Homer pays the $10,000, he doesn't pay Captain Crunch. He pays Spider-Man, the factor. Now, everybody's happy. Captain Crunch was willing to take a little less money, $500 less, to get their money immediately, and then in 180 days or 6 months, Spider-Man got his $10,000. So Spider-Man, the factor, he made $500 on this, didn't he? Okay? And Homer doesn't care. He's got his nice white car and everything is good. Now, if you ever go to a payday loan place, this is kind of what they do. Is let's say you're scheduled to get paid $1,000 in a week, and you need money now. Well, they might give you $950 today, and then they get your paycheck of $1,000 here in a week. And by the way, don't go to payday loan places, because the interest rates, if you figure them out, are exorbitant. Okay, so that's kind of the illustration of a factor. Let's look at a journal entry, how this would work. Okay, let's take a look at an example. Now, when you sell your receivables to a factor, this can either be done without recourse or with recourse. And we're going to look at those two situations, and we're going to focus on the without recourse. So let's look at an example. Let's look at a sale of a receivable without recourse. What does that mean when we say without recourse? That means the factor assumes all risk of collectability. Okay, so back in our example, if Homer Simpson did not want to pay that $10,000, it would be Spider-Man, the factor's problem, not Captain Crunch's. Okay, so that is without recourse. Let's take a look at an example. This is really best taught with an example. Okay, all right. Crest factors $500,000 of accounts receivable with commercial factor company on a without recourse basis. Factor company charges a finance charge of 3% of the accounts receivable, and they retain an amount of 5% of accounts receivable for probable adjustments. We'll talk about that in a second, such as if a customer disputes part of the invoice, for example. Okay, let's take a look at how this would look. First, let's look at Crest Company, who is selling their receivable of $500,000. Let's kind of build this journal entry. Okay, the first thing that they would do is they would credit accounts receivable for $500,000. Put a line there. $500,000. They would take that off of their books. Okay. Now, there is a finance charge of 3% of the accounts receivable. Well, 3% of 500,000 is 15,000. So Crest would debit an account called loss on sale of receivable. I'll abbreviate a little bit. Loss on sale of receivable, and like all losses, that would go on the income statement. Okay. Now let's talk about this thing right here, though. The factor retains an amount of 5% of AR for probable adjustments. Okay. What that's going to be is, well, first of all, what is 5% of 500,000? That is 25,000. And what we're going to debit on Crest's books here is an account called due from factor. Okay? Now, if the customer ends up paying the 500,000 to the factoring company and everything goes great, then Crest will get $25,000 back. Okay? But the factor company keeps this amount in there so that if there is a dispute on some of that $500,000 or charge or something, then they're not having to go back and forth between themselves. And when we have both of these sets of journal entries, you'll kind of see what I mean. Okay, so accounts receivable, we took it off the books. The loss on the sale of receivable is the finance charge of 3%. The amount retained is 5% of AR for probable adjustments. And so the last thing you do is you debit cash. And I kind of think of that as, when I do my journal entries, kind of the accounting plug. So what do I have to debit here to make this journal entry balance? $460,000. Okay? Now, let's take a look at the what would be on the factors books. Okay, they now have an accounts receivable on their books for $500,000. Okay, and they are giving Crest Company cash of $460,000. Okay, now what about that loss on the sale of receivable, that $15,000? Well, they're going to count that as, the factor company is going to count that as interest revenue, okay? And that's how they make their money, is by doing these sorts of transactions. So they have interest revenue of $15,000, and just like they have a due from factor, they have a due to customer for the $25,000. Okay, now let's talk about these. This due from factor is like a receivable, but we don't want to put it in accounts receivable because it's kind of its own deal, kind of its own sort of receivable. This due to customer is kind of like an accounts payable, except they don't want to put it in accounts payable. It's kind of its own deal. Now, you might think that Crest gave up $40,000 to factor this receivable over there. Well, if the customer pays the $500,000 to the factoring company and everything goes smoothly, the factor company will pay that $25,000 back to Crest. So in that sort of situation, they would have only given up $15,000 to get early payment. Okay, but again, this is kept as kind of a scenario if the customer who owes $500,000 and will have to pay the factoring company if they dispute some of those charges or something like that. Okay, so it's not too difficult, but this is the journal entry for both parties without recourse. I'm not sure if that's written on your handout or not, but make sure it is. Journal entries for both parties, and this is a without recourse situation. Okay, now what is a sale with recourse? A sale with recourse, the seller guarantees payment to the factor if the customer does not pay. Okay, so in that case, if the customer would welch on their debt and not pay that, this party over here would have to pay it. But without recourse is the more common situation. And we are not going to do journal entries for sales with recourse. We're just going to look at journal entries in situations when there's without recourse. But in the case when there is a sale with recourse, the seller records an additional liability. Okay, but I want you mainly just to focus on these journal entries on a factoring situation without recourse. I don't want you to worry about the journal entries on a sale with recourse, and I don't want you to worry about the journal entries it shows in your books on where they show borrowing money and using the receivables as collateral. Just focus on this right here, and that will be sufficient. Okay, not a tough topic, but wanted to talk a little bit about that. Thanks. Look at the examples in your book too.